right, welcome back everybody. In this episode, we're talking all things selling property without losing sleep. With me, I've got my property power team. Before we get into any content though, I want to remind you that this podcast is only general in nature. It does not constitute any financial, legal or tax advice or otherwise. It is strongly recommended that you seek personalized and professional advice before you go acting on anything that is specific to your situation. I'm joined by Michael O'Malley, mortgage manager from Rate Money Sydney CBD, Andrew Chan, strategic financial planner from Phoenix Private Wealth Management, George Coletti, principal accountant from Access Professionals, Daniela Musitano, executive and founder of Title Space Conveyancing, and myself, Gianni Musumeci, investment property advisor from Leverage Property Advisors. I want to kick off with George. The biggest item when it comes to selling, especially investment property, is capital gains tax considerations.
Yep.
How can people avoid or at least reduce legally capital gains tax?
I think we sort of covered this in another episode. The most important thing is keeping your records. Having the accurate figures of what it actually costs you to buy and all transaction costs in relation to that. Even interest costs and holding costs, if there was a period of time where it wasn't being used, can add to the cost base. So you've got to be very mindful that circumstances change. Was there periods of time it was a principal residence? Was it a principal residence to start with? At what point in time are you selling it? Is the next one that you're buying, that you're living in or have purchased going to be less of a capital gain if we use the principal residence exemption? There are so many different circumstances. But the key is to ensure that you've actually got really great record keeping.
Yeah, okay. So that's important, especially when it comes to reporting and whatnot, because that will calculate your capital gains tax essentially. And there's a few different circumstances involved there as well. But it may be coming back to a financial planning perspective. If I'm considering selling down the track, how can I prepare for something like that, Andrew?
Yeah, working with George, it's important. Part of the record keeping is, if you're, for example, we were talking about tax concessions. So the assumption is that they have some. So they're living in the property at the time and they move out. And so you have the CGT exemption on your principal place of residence, and that can last for 6 years, even if you rent it out, right? And you can also move back in and you can also refresh that, right? So, but the minute you let it tick over that 6 years, then at that point, what you should do is get a valuation, because you can prove at that point in time that that's the valuation in time. If you don't, then you expose yourself to leaving to the tax office to come up with a valuation, and that valuation might be estimated prior to that date, but that prior date might be 30% more less of a cost base, which increases your capital gains. And so just be wise in those situations, and tying back to in relation to record keeping is, if you do want to keep your property, then at some point we might find that we might never sell that property in our lifetime. So then even though you keep those records, just make sure you those records might become obsolete, but don't assume that. So just keep them all the way to the point of your estate, because if it passes to that point of the estate, then it can be dealt with then. But in a nutshell, it's all about, if it was an investment property, then it's just simply, as George says, anything that, any capital costs that you attribute to, nothing that's deductible. People sometimes confuse the two and they want to chuck everything in. Make sure you can have you can make sure that any improvements, renovations, all those sorts of things, they're great. But yeah, you're also stripping out your depreciation as well.
Yeah, I think moving back to goals-based advice, like once the property has achieved that goal, whether it be a capital value, more than likely it's going to be a capital value because you're selling it, you are then considering timing your exit as well and the costs associated with that.
Yeah, so there's costs in terms of agents' fees. So, often in financial planning, we use property to accelerate wealth creation and accumulation. Because it just makes sense. It's just easy. You don't have to think about it too much. And you're diversifying between asset classes once you've purchased your property. But the reality is that after they've done what they need to do, the properties tend to be older and a bit more worn. And so there's a bit more work that needs to go into maintain that. And when you move to a different stage in your life where you're now drawing down income, if you don't have sufficient properties in your portfolio to yield you just rental income and you can just sit on it, you might find as you're older, you don't want to deal with the complexities of that. So you'll start to sell down property. And so, what you're saying to George is to say what helps you sell down property is wait till you're not working anymore. It sounds really simple, but like if you're earning 200 grand or 300 grand a year, and then you're paying tax at 46.5 cents in the dollar, it's very different when you just pare that back and then you can start again, you can sell. And so in terms of when we're strategizing on when to do these sorts of sales and divesting, it can make sense. And we had a conversation earlier about whether we buy joint tenants or tenants in common. Then you can sometimes get around if one partner retires earlier, that they can sell their portion to someone else if there's someone else who's taking over the property that is within their circle, right? And so in that basis, when you're selling property, there's not only the tax element, but there's also what you're going to do with the money. There's another example when you're selling property that for financial planning, probably not appropriate, but I'll raise it, is now people aren't aware of, is that you can make downsizer contributions to your super fund. So you're over 50 and you're fully retired, or you're not fully retired, like you're over 50 and you've lived in a home for more than 10 years and it's your principal place of residence, you can put $300,000 into your super fund. So example of the family home is own joint tenants. You can have the husband and the wife. So, often when we buy property, I say, think about not only you pay off that asset, but you also think about how much you need to live in retirement. So sometimes the properties in Australia are so expensive, it just takes up so much resources. And then in the end, we're often very asset rich and cash poor. So it's to say, okay, this is a vehicle which we can drive our wealth, and we can have a larger asset value to drive that wealth through gearing. And then when it's time, then we downsize to a smaller property, get the finance, or if we want to do, if you have no dependents, you can have finance. If you have dependents, well, I do have clients that they name their fund the ski fund, spend the kids' inheritance fund. But really, what we have is a situation where you can unlock that equity and then spread all your assets. Again, we can and support and also live in a home and put money to more efficient tax structures like superannuation to fund that retirement. So it really gives them options. Tax is a secondary consideration, is what I'm saying, and the fact that the asset and what it would do, and it's a quality asset that will appreciate over time, that's where the focus should be.
I'm finding that a lot, particularly people that get to retirement and they spend a lot of time, like you said, properties are very expensive, but they get to retirement, they've worked hard to pay off their debt by retirement, and then all of a sudden, then they consider their retirement. They say, oh, I've got no superannuation because I've put it all into my home, and they have to either downsize or do a reverse mortgage. So it can be a very difficult thing to consider as well, your finances when it comes to that. I wanted to step back a little bit and talk about it from a lending perspective. Now, a lot of people might not think about this. They just sort of think, oh yeah, I'll pay off the debt when I sell my home. But how do you consider lending when you're selling, and what are the implications of selling still under debt?
Yeah, look, selling a property with a mortgage is a very normal situation. That's not uncommon at all. But the one inescapable law is that when you sell, the bank gets paid first. So if you sell and there's excess funds, you get to keep that. But, property, we live in an environment where we're a bit accustomed to property constantly on an upward track, but the grey hairs around the table can remember a time when that wasn't necessarily true. And property values can fall. And if you, in that situation, if you're selling in a falling market, or if your sales price is low, you can end up with negative equity. And the problem with that is that you've got to make up that shortfall between the net sales proceeds and the lending. So you'll end up having to pay that back to the bank. The other consideration is from a borrowing perspective, it doesn't really make sense. We've been in an environment where we've seen recently, thankfully, mortgage interest rates coming down. And so fixing your loan at the moment in a falling interest rate environment doesn't really make sense. But there are plenty of legacy fixed loans out there. And if you break a fixed loan, there can be quite substantial fixed rate break costs. And you want to take those into consideration before you pull the trigger and make that decision to sell.
And at a high level, what are they? Typically, it's you have to pay the remainder of the interest plus a fee or something like that?
It's a bit of a complex calculation, and you can never really guess what the number's going to be. You go to the lender and they'll tell you what it is. But, I mean, it relates to the funding cost. Banks have funded your mortgage at a certain cost at a certain point in time. And if they're penalised by that, then the break cost can be pretty substantial.
Yeah, fairly significant.
I think it's important to note from Michael's perspective too, the age of the person is really, really important. Because
my perspective,
no, I'm saying from our perspective, when you get to a certain age, you need to be actually talking to your broker probably first before you go hitting the trigger, because your next borrowing might not be approved because you're at an age where the banks and funders are saying, hang on a second, what's your exit strategy? Do you actually have that?
Yeah.
Mike, you want to talk about that? That's
Oh, yeah. I mean, for virtually every lender that I deal with, if the applicant's over 50 years old, we need to provide a written exit strategy that looks in detail at what they're going to do. And it'll consider things like, what's your asset profile? What are your savings like? Do you have other property that you can sell? Those sorts of things. And we need to really sort of drill into and rationalize what the exit strategy looks like. And it has to make sense.
I've had to write a couple.
Yeah, that's right.
Because funnily enough, banks want their money back. Because funnily enough, banks want their money back.
Yes,
yeah,
they do.
absolutely.
Strangely enough.
Yeah. People might not think of this, but what are some of the legal considerations that people need to understand when it comes to selling their property?
If they haven't spoken to their accountant first, it's capital gains tax because that is calculated from the date that the contract is signed, not the day that it settles. So you might have signed a contract in March with a settlement in July, whatever, long settlement. Capital gains is from the date of sale.
Yeah.
So that is something, especially this time of the year, we see a lot of clients say, prepare the contract, but not signing it until 1st of July. So we're sitting there, hanging in there, waiting for that 1st of July to kick in. But that means they've got the advice beforehand, and we don't really need to provide it ourselves.
Yeah, that's important.
But when a client that tells me, I'm selling my investment property and it's around, April, May, I'm like, okay, are you aware of this? Do you know when are we keeping it within this financial year? Are we, holding until, 1st of July onwards? So.
And Danielle's job is harder from that perspective too, more recently, because now you need clearance from the ATO in order for her not to withhold the portion for capital gains tax.
And from 1 July, exactly. So it used to be up to $750. Now every single vendor needs to apply for the clearance certificates to prove that they are Australians and not foreigners.
Yeah, and then that way they have money left over so that the government can get their cut as well.
There you go.
Yeah. Yeah, I see a lot of people, especially this time of year, at the moment we're in June, and a lot of sales agents will be, yes, the property is on the market. However, we're not signing the contract until 1 July. I find that case is a lot. And that's to Andrew and George's point, where you're looking to time your exit depending on your level of income in this financial year. So often you'll have a chat with your financial planner and your accountant to say, how are my finances looking around about April or May? And they'll say, okay, what do I need to do to pay less tax this financial year? And say, yes, you can sell the property, but don't do it until 1 July. So I'm finding a lot of that in the market.
Point of clarity on that too is that it's actually not the date of settlement. It's the date of your contract.
Yeah.
So it's when you've entered into the contract, which is when your CGT events happen. So people think, I actually did it, I'm settling in after July.
Yeah.
But you actually signed the contract on the 30th of June.
Yeah. It's the difference between contract date and contract date,
Correct.
not settlement and settlement, or contract and settlement. Yeah.
There's also changes in superannuations that the law recently changed where it allows people to not meet a work test to put money to superannuation. So you're no longer in your 60s, mid-60s is now up to 74. So, you might be in a situation where you have large capital gains, you're starting to realise, and you put that away, but you can also make concessional contributions. You don't have to be a business owner to be able to do that. Every individual can do that now. So there are ways, if you're not working, to still mitigate some of that tax.
I think they're directing that to us.
But what I want,
we've got income.
Oh, we're talking about reasons to sell and bad levers and legal reasons, but I'll probably highlight a different perspective when selling property is that sometimes in all the best planning, you can sell because we've worked out why, it's a great area, the suburb is exploded. We bought in Brisbane because we knew the Olympics was coming and look, everyone's just flocked there and now we're going to sell at the right time. But there are situations where they're bad lever clause situations. And some of the experiences that I've had is, first home buyers or buyers, inexperienced buyers have bought, and then they're bought unknowingly in a catchment. And the catchment could be they're near housing commission. And if you haven't done your research or it hasn't been done for you, you can fall afoul because the neighbours might not be the quiet neighbours that you're hoping for, and that can affect the sale price, right? Or you can buy in, say, a heritage or conservation area, and that can really impact the sale value as that happens. And so, the good lever side is, if you're on Auburn Council and you know where the planning provisions are going to change, and if you knew where to buy, then that'd be a totally different situation. But the appreciation of those considerations need to be considered. And so from a financial planning perspective is that we buy property and it's bought at a point in time. But there can be circumstances that are unforeseen with all the checks and balances that might require you to reconsider whether you're going to sign up for the next stage in that assets. And a good example of that is when you're struck with a special levy. So we often have these huge apartment blocks with all these shared amenities, services, gyms, pools, lifts. And when those lifts come time to change over, you're looking at hundreds of thousands of special levies, and depending on how many people in your apartment block, it's not an insignificant sum.
Yeah. You need a good conveyancer to check the sinking fund.
That's right. That's right.
Highlight that because that actually happened to one of our clients.
Yeah.
They actually came to us and said, can you have a look at this property because I'm thinking about buying it. And we had a look, and the actual the balance in the Strata reports said that there was negative $1 million in their sinking.
I always say the Strata report often. It's more important than the contract itself.
Agree.
Yeah, because there's certain milestone events, especially in an apartment where, yes, you change the lifts or change the plumbing, or you need to paint the outside of the building, or especially in New South Wales, what's happening now is the state government is telling everybody they need to review and potentially change their cladding on the outside from the petrochemical to something else. So yeah, the strata endpoint is super important, and that could also be a factor in selling as well, like whether or not you sell your property for that price. And I think that there was come to a period where, especially during COVID, where people were buying under ultra low interest rates, like never seen before interest rates below 2%. And then a couple of years later, we had a bit of a sharp increase in interest rates. People were finding themselves in dire straits where they were like, I bought the property based on that period in time, but now I can no longer afford it, and they were forced to sell a result. And this goes back to the financial planning. Like, you need to buy with the end in mind, not at this time, because I tell people that in a booming period, you can sell anything. Like, people will buy anything through scarcity or hype or FOMO. But then when it comes time to sell, like, you actually need to market your product, and you might not get the price that you want. So that's something that you really need to consider. But look, thank you everybody for your time. And that was really a lot to unpack there, and a lot of considerations around selling. So I really appreciate it. Thank you guys for joining us.
Thanks,
Thanks, Johnny.